Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra and it's the earnings season. We're going to be focusing today on India's leading FMCG major, Dabur's Q4 numbers now. And joining in to decode the earnings fine print with me, I have a very special guest joining in. Mr. Ankush Jain joins in. He's the CFO at Dabur. Welcome, Mr. Jain, and thank you so much for taking the time out. Appreciate you joining in on Business Today TV.
Yeah, thank you, Sakshi. Good afternoon to you and all your viewers, and good to have me. Thanks for having me here.
Sir, let me begin by understanding from you. In Q4, we've seen that the revenues that Dabur has posted, they look steady, but there's a dip in your profits, about 22% or so. There's also an exceptional loss that you've posted. Could you help all our viewers understand the key reasons behind all of this?
Yes, actually, definitely. But before I go there, just a glimpse of overall highlights. Full year, we are pleased to, inform that we have crossed 10,000 crores as an important milestone in revenue. We have, in fact, clocked 10,900 crores as revenue for the full year, which is a growth of 14%. And in the year, we have added more than 1,000 crores of profits, 1,300 crores profits, revenue have been added. And even operating margin has grown by almost 12%. So phenomenal growth backed up by 10% overall volume growth. Now, coming back to your specific question on Q4, the environment definitely remains very challenging. But amidst that, we have been able to declare results of 7.7% or so in terms of revenue. But you're right, in terms of operating margin, it increased by 2.5%, though on a yearly basis, we have been able to maintain our margins despite this inflationary environment. But Q4, the levels of inflation, in fact, heightened. Plus, there was also a category, mix, because the base had high saliency of health supplements and healthcare, which are more profitable than foods, and foods grew by 34%. So that impacted a little bit on margins, but on a yearly basis, we were able to maintain our margins. And in fact, despite this inflation, from last to last year basis, our margins have expanded by 10 bips.
Okay. Sir, also could you help us explain what is the exceptional loss on account of, and is it a one-off in this quarter?
Definitely. This exceptional loss of 85 crores, this is impairment of goodwill, which pertains to one of our subsidiaries, Hobby Cosmetic, which we acquired, almost a decade back. And this loss is primarily, or this impairment is primarily because of currency devaluation, while the local business and the local country in local currency is growing by 20 to 25% year on year, last 4 years, and even in last 10 years, it has grown by CAGR of 20%. But because of currency devaluation, when we consolidated in India, it devalued by 40%, Turkish lira. That resulted in devaluation losses, and consequent to accounting standards and fair value representation, we took this one-time exceptional loss of 85 crores, and this is a non-cash item. It's an impairment of.
Understood that, sir. So since you've been talking about the high inflationary pressures, and that has been a concern in this previous quarter, could you also help us understand, do you anticipate input cost pressures to also continue as we move forward in Q1 and the further quarters as well? And if there are any steps that you're taking to mitigate these risks?
Sure. Definitely, Sakshi, the inflation pressures continue. Inflation is unabated. It continues to be almost nearing double digit for our business, on top of near double digits, so meaning 2 years of 20% inflation, which is really high. At least we have not seen it in 40 or 50 years, and globally. Even as per government data, WPI also touched 14.5% in April. So it is the biggest concern as we speak. And therefore, we expect there would be margin pressures in the near term. However, having said that, our intent is clearly to at least protect our operating margins on a yearly level. But as I said, near term, there would be pressure. We are taking a couple of steps. We would be, taking calibrated price increases across our portfolio. So we match our, portfolio to portfolio where we can take price increases, because our brands have pricing power. We have taken almost 5 to 6% price increases in last 1 year.
Right.
And we would continue to evaluate that depending on competitive intensity, point number one. Also, we are looking at our cost saving initiatives in a much more sharper way. We are evaluating each and every line of our P&L, doing value re-engineering. We embarked on a journey of Samriddhi project last year, which gave us 60 crores of savings in I think FY22, and almost equivalent amount in the previous year. So we will continue to embark on that and press the pedal even to accelerate it further. So a lot of things are going on, and yeah, we would also be rebalancing our total ad pro spending to optimize it further.
Okay, so help me understand on the price hike front, sir. You did say 5 to 6% price hike was done in this last year. If you could help us, with the visibility on the quantum, what could we expect going forward from here, even if it is going to be calibrated and spread across several quarters of the new financial year? How can we expect, and what will be the quantum?
Yeah, it's a difficult question. Penning down an exact number or an approximate number at this point of time is difficult because we are still evaluating. The environment is very volatile, and uncertain, also because of geopolitical situation, the inflationary pressures. But having said that, we would be, depending on the situation, again, we would have to probably take a similar level of price increases even in the current year, 4 to 5%. If need be, we can take it further, or depending on cost pressures, we are flexible on that.
Right. So on the inflation and the input cost front, again, I wanted to understand what has been the impact on demand in this quarter, especially in the rural demand area, and what's the outlook both on the rural and the urban front demand going forward from here?
So demand, yes, when we started this fiscal, the demand of volumes was almost 20%, but since then it has been going down for the industry as a whole. Q3 it was almost flattish, but Q4 FMCG industry per se declined by 4% in Q4, while we still managed to grow by 2% and we still increased our market shares. But because, coming back to your specific question, because of high inflationary pressures, we are seeing a contraction in demand because of a couple of reasons. One, obviously, the purchasing power or the disposable income of the consumers at large is being impacted. And consequently, they are probably cutting back on discretionary items much more than staples, because you have a limited basket of resources to spend. Secondly, what we see, they're also down trading to some extent and deferring bigger ticket item purchases. So this is also impacting demand. However, having said that, we see this trend to continue for at least 1 or 2 quarters, if not more. And with the probability, however, of good monsoons, good normal monsoons, and also probably if the government impetus on capex cycle, which should revive in couple of months, there'll be some lag impact. So we think later part of the year it should be better, but near term there is a demand demand concerns. Now again, rural and urban, for us, by and large, rural was higher than urban. But in this quarter, while syndicated data shows that rural has declined at a faster pace, almost 5%. But for us, it has been by and large same, almost similar levels of growth. But yes, as we speak, we see a bit of stress in the rural, given the inflationary pressures, and also given not only the inflationary pressures, but liquidity crunch as well.
Right. So given the concerns that you pointed out in the rural areas, have you actually noticed a shift into, say, lower price packaging from your FMCG business, especially the food and beverages business as well, and the personal care business as well? If you could help us understand if there is this trend that has changed because of the higher inflation.
Yeah, in fact, even in this inflationary environment, in fact, the food business has been doing phenomenally well. It grew by almost 33% in the quarter and for almost 47% in the year. While we don't see much of down trading in the foods and beverage business, but in the personal care, yes, there are trends of down trading, especially in oral care or hair care businesses. Yes, there is a little bit of trend of down trading, because as I said, the disposable income and the purchasing power gets impacted in the
Absolutely. Now, in terms of the product portfolio, again, I wanted to understand from you which are the segments that have actually contributed maximum to the revenue, since you said that this has been a very good year in terms of the revenues overall consolidated that you've talked about. So, which are the segments that have contributed maximum to the revenues, and which ones will be the growth levers even going forward in FY23?
Yeah. So in fact, in the current year, foods business has grown by 50%,
Hmm.
which is phenomenal. And even on a 2-year basis, it is 18%.
Hmm.
Healthcare business, though has grown by 5%, but on a 2-year basis, it is 18 odd percent. So it's similarly double digit levels.
Yeah.
The healthcare business specifically, which grew by 40 odd percent in last year, it
Hmm.
has grown on even that high base.
Hmm.
But obviously the growth, will though the growth will continue as the awareness and the penetration levels of immunity based products like Chyawanprash honey has definitely increased over last 2 years,
Hmm.
because of COVID and because of people's intent to increase their immunity and from natural based products. So it has increased, but the growth will mute. It will not be
Hmm.
as high as 40-50%, which we saw in
Okay.
2 years. And HPC also has grown by 13% in this year, again a
Hmm.
double digit. So by and large, all our product segments, whether it's foods, whether HPC, or whether healthcare, have grown double digit CAGR in 2 years.
Hmm.
Going forward, I think at least in this year, the visibility which we have in short term, foods continue to grow at a much faster pace.
Hmm.
Within HPC, I think oral care and hair care should start doing well,
Okay.
shortly. And though we have still gained market shares, and the growth will come back after
Hmm.
Q4.
Hmm.
And health supplements also will increase, but not at those rates which were 40-50% exceptional growth. So by and large, the business has rebalanced. And in the current year, however, foods will grow much higher.
Okay, understood. And last question to you, sir. Since we've been talking about this changing macro setup, higher inflation, high interest rates now becoming a reality, the pace of growth overall in the economy is slackening as well. Looking at all of this setup, what is the growth outlook that you have for FY23 when we talk about margins, volume, as well as all the other important factors when you talk about in the earnings?
Yeah, I think as you know, this is an extremely volatile and uncertain times
Yeah.
because of inflation, because of macroeconomic conditions as well. But our intent is that we grow our revenue by at least high single digit,
Hmm.
and touch at least double digit, low double digits in terms of revenue,
Hmm.
which would then obviously be backed up by price increases of 4 to 5%, and balance should come from volume increases.
Hmm.
But having said that, this is a yearly intent we have. We are working towards that. But quarter on quarter, giving a guidance will be very difficult.
Yeah.
Reason being that in quarter 1, we enter into an exceptionally high base. Last year, we grew
Yeah.
by 30%. Our health supplements, because of second COVID wave,
Hmm.
grew at almost 50-60% again. So growing from that levels will be extremely difficult. But on a yearly basis, this is our intent.
Hmm.
Coming back on margins, there will be near-term margin pressures, at least in H1,
Hmm.
because of the inflation, and because we had cut down on significantly, discretionary cost in Q1 and Q2 of last year because
Hmm.
of COVID. But we have, as I said, accelerated our cost-saving
Yeah.
initiatives. So on a yearly basis, though we want to protect our margins, but
Hmm.
in a near term, there would be some pressures on margins.
Okay,
And
understood. Yeah.
yeah.
Yeah. Please continue, sir, if you wanted to make a
And
point.
in fact, I think I also covered the other part on volume. On a
Yeah.
full year basis, out of that 9 to 10%, high single digit revenue growth, mid digit should be volume, and balance should be from pricing.
Okay, understood.
And I think just one more point, depending on the macroeconomic situation,
Yeah.
while the numbers are, will pan out, but our intent is clearly to win in the marketplace, to
Hmm.
gain our market share, like we have done this year. We
Hmm.
have increased our market shares in 99% of the categories.
Okay.
And even standard that that's in Chyawanprash, gone to 65% market share, and
Yeah.
even honey, it's 300 bips each in
So what
Chyawanprash.
is your target for the market share, sir, in all these segments for FY20?
Market share, target is difficult because it will depend on competitive intensity as well. But we will definitely keep on increasing. Last 2-3 years, we have, increase our market shares consistently across the areas we play.
I had one more question which I wanted to ask you: if there is any consolidation, M&A, or acquisitions on cards, in several brands that are emerging in the new digital space as well, on for you.
Yeah. Sorry. Obviously we are evaluating. We keep on evaluating and are contemplating M&As, which are synergistic to us, depending on portfolio synergies, depending on geography synergies, and also D2C brands which are emerging. We are evaluating, but as of now, we don't have anything on the table currently. Which we are aggressively pursuing, and we also believe now with the market correcting, now the valuations should become reasonable, and which would give us opportunity to reevaluate them as we go forward. But we are open to M&As, and as you know, we have war chest of almost 6,000 crores, and we would definitely want to do some M&A, and grow the business further.
Okay, understood that. Well, on that note, thank you so much, Mr. Jain, for speaking to us and sharing all your thoughts on the earnings factor, helping all our viewers understand the fine print of the earnings as well. And all the very best to you for the future quarters.
Thank you so much. Nice speaking to you.
If you like the video, do like, comment, share, and subscribe.